Hi, I'm David Stein of Money for the Rest of Us. This channel is on money, investing, and the economy. And in today's video, we're going to take a look at cryptocurrency lending. Really, cryptocurrency lending for beginners. I've been investing in cryptocurrency since 2015. It's well over 5% of my net worth, but it was only this year that I opened up a cryptocurrency savings account with BlockFi. And we're going to take a look at the risk of cryptocurrency lending and how it compares to traditional banking. Let's start then by looking at, well, who would want to take out a crypto loan? The main borrowers, or the basic use case, is if you have a lot of Bitcoin, let's say, and you don't want to sell it because it will incur a capital gain. For example, this year, I sold some Bitcoin. After a number of years, it was up substantially, but I wanted to buy windows for our house. So I sold some Bitcoin, but now I have to pay capital gains on that. What I could have done is taken out a crypto loan, borrowed dollars, and the Bitcoin was used as collateral for that loan. Another reason that people will want to borrow cryptocurrency is speculators. Speculators believe Bitcoin or some other cryptocurrency is going to go up in price. And so they're willing to borrow it, and they think that the appreciation in that cryptocurrency will be greater than the interest rate that they're paying for the loan. The third reason then that crypto loans exist is there are market makers that are buying and selling cryptocurrency, and they want to get access to inventory. So they'll go to a platform like BlockFi or some other entity, and they'll borrow that cryptocurrency. Now, here's some of the interest rates that the different platforms are paying. BlockFi, where I have an account, it starts out at about 8% for really the first $40,000 worth of using their particular stable coin GUSD. After that, the interest rate drops down to 5%. But you can see there are a number of platforms. Some are more traditional. Some are very much kind of an automated platform, is what is known as DeFi. And I'll share a podcast episode here in a few minutes where we dive deep into DeFi. But today we're just talking about cryptocurrency lending, the very basics. Now let's compare crypto savings accounts versus bank savings. Crypto savings is what is known as shadow banking. And that's not a devious term. What shadow banking means is that there are financial entities that do some of the traditional roles of banking, but they're not regulated, whereas a traditional bank savings account is regulated. Now, clearly, crypto savings pays higher interest rates, 8% or so, whereas at this point, your checking account at your bank will barely pay a little more than zero. Crypto savings, though, don't have any type of insurance. They're not government regulated. They're not government protected. So if the platform goes bankrupt, you don't get your money. Whereas a traditional banking account, there's depository insurance. So if the bank goes bankrupt, and I've had that situation before, I was with a bank, it was insolvent, and the account got taken over by somebody else, and my savings were perfectly fine. That's not the case with cryptocurrency. Now, crypto savings, the actual currency is denominated in cryptocurrency, and your interest you receive will be in the cryptocurrency you use to fund the account, be it Bitcoin or some type of stable coin. Whereas a bank savings account is denominated in the fiat currency. If you open up a US dollar bank savings account, that's what the interest will be in. With cryptocurrency, some of these platforms, if you can ask for the funds, and it's typically you'll get that within 1 to 2 business days. With a bank, you can pull cash out, pull it out of an ATM, or you can go to the bank branch to get that cash. Both banking and cryptocurrency platforms, they have a similar business model. They earn interest on loans, and they charge fees, and they want to make sure that income is greater than they're paying out in interest on deposits. Now, with crypto savings, these platforms, you really don't have any transparency. A lot of these are venture funded. BlockFi, for example, just raised another $350 million in capital early in 2021, but we don't know what their financials are. We don't know if they're profitable or not. Whereas with a bank savings account, you can pull up their financial statements. There are also other bank rate or other entities that rate banks. And so we get a pretty good idea how solvent that bank is. That means that crypto savings is risky because we don't know the status of that particular platform. Let's look at some of those risks. The first is the default and bankruptcy risk. Because crypto savings accounts don't have FDIC insurance, if the platform goes under, and again, we don't have that transparency, then you potentially will be out of those assets. The other type of risk is credit risk. These platforms are taking credit risk because they're lending out this cryptocurrency. It's not staying in the account. It moves on and somebody else uses that cryptocurrency. They want to borrow it, and so they get it. And so it's not there anymore in your account. It's just there's an accounting entry. Now, the way that these platforms try to protect themselves is through over-collateralization. They ask that the borrower in cryptocurrency put up more money than they actually borrow. And so if the cryptocurrency falls in price, they have that collateral to back it. Now, some platforms will do under-collateralized loans where they'll just lend the money out and they'll do credit research on the particular entity that borrowed it. Let's say it's a hedge fund or some other platform. And so there's truly credit risk there because there isn't any collateral backing the loan. There's also liquidity risk with these platforms. While in the normal course of business, you'll be able to get your funds in 1 to 2 days, most of these platforms have some type of language that says under certain circumstances, they can freeze deposits and you can't get your assets out. Now, that doesn't happen very often, but that's definitely a risk. And then a final risk is the regulatory risk. BlockFi, for example, has been notified by New Jersey to cease and desist. And BlockFi is working with the state, the regulators, to try to work that out. But New Jersey's position is that these crypto savings accounts is a type of security and they should be regulated. And most of these platforms just aren't regulated at all. And there's some regulatory risk. Will they continue to be allowed to exist? I think they will, but that certainly is one of the concerns. Now, as I mentioned, opened up a BlockFi account earlier this year, and pretty simple. Mine is denominated in GUSD, which is a stable coin that's backed by the US dollars that BlockFi has, and it's gone fine. My interest is paid every single month. There's been no issues, but I recognize that this is a risky investment. The reason why it pays 8% is because there's a risk it won't be around in a couple years. We'll see, but I think in my case, I invested about $25,000 and I'm willing to speculate on that to try out the platform to see if it works, but I'm willing to accept that if I lose it all, I lose it all. Now, if you want to learn more about cryptocurrency lending and BlockFi, I have a podcast episode. It's episode 339 of the Money for the Rest of Us podcast. You can check out that particular episode and learn certainly about cryptocurrency lending, but also how DeFi works, how DAI and MakerDAO works, and some of these more automated crypto loans that are completely open source and there's no individual entity involved. It's a really, really fascinating area. But for now, this is cryptocurrency lending and savings accounts for beginners. If you have any questions or comments, you can leave those below. If you like the video, go ahead and do that. Thanks.